Nigerian Stock Exchange ended the first trading week of 2021 in the red as losses recorded on the second and the last trading days eroded gains from the other trading days of the week. The all-share index declined 0.4% last week to close at 40,122 points. It is really early days, but so far this year, the market is down nearly 0.5%. Joining us to discuss this further is Mohammed Garba, director and co-founder of Cardinal Stone Partners. Good morning, bright and early Monday to you. Let's get this conversation started. Mohammed, let's begin with the returns the Nigerian investors made last year on the stock market. What was responsible for this in spite of a tumultuous economic year in the country in general?
Thank you very much and good morning. Last year was largely influenced by liquidity. We saw quite a lot of funds without investment opportunities. So the stock market, to a large extent, benefited from that. On the back of that also were very low interest rates. Savings account interest rates were dropped. Deposit account interest rates also came down. Treasury bills were down. And so investors generally were looking for where to invest. And they found the stock market as a very strong and veritable investment opportunity.
So we've started the new year. What do we make of the pullback we saw last week?
Sorry, I didn't get that.
We're starting the new year in a bit of a soft level. So what do you make of the pullback that we saw in the market last week?
I think that's typical. There are a combination of reasons that led to that. Firstly, there was the typical Santa rally. The average weekly trading volume for December was on average about 42 billion weekly. Last week, we saw roughly about 25 billion. So the market was down roughly about 40% in average weekly volumes. Quite a lot of fund managers had not resumed work. And then the typical Santa rally, the market had gone up and investors, the market typically rallies for a number of reasons in December. Firstly, there's portfolio rebalancing. Quite a lot of investors try to rebalance their portfolio. On the back of that, we saw profit taken last week. And then chief of that was most of the largely capitalized companies, Dangote specifically, had announced the share buyback. And that really influenced the performance of the market because the price went up.
So can you put your finger on the sentiment driving investors on the stock exchange as we kick off the new year? What do you think the playbook really is? What's on the horizon?
There's still a lot of liquidity. So ultimately, in the long term, the market will still continue to rally. That liquidity still needs to go somewhere. Across board, asset classes are going up. It's happening in real estate. It's happening in even commodities are rallying. So largely, there's so much liquidity. We still expect the stock market to do well this year. At least specifically this quarter, with the clarity we're seeing and with the amount of information out there right now, this quarter will still do well. Governments generally, globally around the world, are still trying to jumpstart growth. Growth is a key essence that ties most economies right now, and Nigeria is not an exception. So we'll still see a lot of liquidity because governments have tried to use monetary policies, unorthodox monetary policies specifically, to try to drive growth, and we see this continuing for some time.
I'm beginning to get a little bit tired with the one step forward, two step backwards with insurance sector consolidation and recapitalization. So I'm asking myself, I'm getting weary. Do you think investors are getting tired of this process that seems to have no end?
Yes, sadly, investors are. We need a very viable, very strong insurance sector, no doubt. Similar to the benefits we saw accrue to the banking sector. And between 2004, 2005, during the consolidation era, we were able to attract quality. Capital was strong, and so human capital too became a benefit, and that impacted the market, the banking sector. Similarly, in insurance, quite a lot of the insurance we do in this country is still ceded to foreigners because we're not well capitalized. This has to be done. Sadly, this is the whole sector. I think the NICOM recently cancelled again the privatization on the back of a court order last week. That's the third time it's happening in 2 years.
Yes.
Sadly, it's something that has to happen. We cannot run away from it. Banking sector, we have to take the bull by the horn. I think we've gotten to the point where this just has to be done. It's a strong benefit for the economy and for the market as a whole.
So there were notable sell-offs last week in some names, big names that drove the market down. We talk about Dangote Cement, Unilever, MTN saw a bit of investors taking a bite. Do you think a handful of blue chip stocks drive the market, in your opinion?
Yes, definitely. I mean, blue chip stocks make up about 17. I mean, the top 10 most capitalized companies make up about 17 trillion in our market.
Out of 20?
Yes, exactly, out of 20. And if you even take the top 5, all of them are all trading above 1 trillion. Yeah, and so at any point in time, once all the top 5 companies, any of them that drops or gains materially impacts the market.
Do you think it's time to take a second look at this particular situation? The authorities, the SEC in Kenya is looking at this particular situation in which you have big names like Safaricom, Equity Holdings. Once those companies sneeze, then the rest of the Nairobi Securities Exchange begin to shake. Do you think we should look at that here?
To a large extent, I think it's a much bigger problem. Since 2008, we've had only one IPO in the stock market. Every other company that has listed has been largely through listing by introduction, which means very little liquidity. I think the real focus should be how to bring in more companies and encourage IPOs. I think the time is, we're gradually getting there. Prices are rallying, and so this is a good time to see companies come and list. If we have the right float.
What will bring the companies in to list? Give me some specifics.
Sorry?
What will bring an IPO? What will reopen?
I think to a large extent, it's that pricing. If I'm not well priced, there's no way I'll come and list. So for a very long time, stock prices were low, and it wasn't attractive enough to encourage equity raise. Yeah. This year, I think that would happen. We've started with very low interest rates. I think interest rates will gradually rally. And so until we get to the right equilibrium, up until then, stock prices will still be high, and I think by the second half of the year, we'll gradually start seeing equities, companies come to raise equity.
Do you think a demutualized stock exchange could give that a fillip?
Fabulous. Yes, that's something we've been waiting for. It's very key. A demutualized stock exchange materially improves competition because returns, they're now accountable to shareholders. So the whole narrative changes. Strategy will change. There's going to be much faster approach to doing things. So yeah, demutualization, no doubt, will materially impact the market.
And perhaps the share price of the Nigerian Stock Exchange itself will be the bigger size of the market. I know you folks are waiting. I know you folks are just waiting. Everyone is waiting on the wings for that. Interesting. We'll talk about insurance already. Let's move on to one other part of the conversation, which has to do with the financial services industry, banking sector, for example. What's your take on that?
Banking will still continue. Right now, banking will still continue to do well. That's my view. It's still the most liquid sector. There's way more transparency in the banking sector. Interest rates are down right now, no doubt. But they've been making monies from fees. Banks also have the opportunity to materially reduce their expense, so cost-to-income ratio would go down. So this year, I think, will be fairly okay. And by next year, or by the second half of the year, like I said, interest rates will gradually inch up, and that's very positive for the banks. So win-win. I mean, they've had huge costs, and there's a lot they can do to manage costs. So I still see the banking sector as a win-win. Liquidity is important for investors, and banking stocks provide this opportunity opportunity also. So it's typically one of the first companies investors, one of the first sectors investors look at when they try to invest in the capital market.
I don't think anyone has a portfolio without any bank in the basket.
Absolutely.
So I'm worried how we are getting it right here. I'm just looking at the Kenyan market where nearly almost all the banks are already issuing profit warning, and not a single one in Nigeria.
Yeah, I think it's largely the composition. Most of the banks, to a fair extent, a lot of banks had prepared for this. And that's why you're seeing non-interest income materially increase in the banking sector. So we've seen that help reduce losses from interest. So I think a lot of Nigerian banks prepared for this. We've seen this before. 2016 caught a lot of banks unawares. I would say 2016 into 17, yes, where we had our own homegrown crisis. A lot of banks, a lot of manufacturing companies all across, we had prepared for this. The supply chain for the manufacturing sector has materially changed. A lot of them are looking inwards. So 2016-17 prepared a lot of the banks. Generally, the market prepared for this much better.
Let's talk about the consumer goods sector. Was up 2.6% last year. It looks like the big names, Dangote Sugar, flour mills, the rest of them, it looks like they're moving on. Is that sector still driven by disposable income in Nigeria, or you think that we are beginning to engineer some things locally, local manufacturing is beginning to rev up somewhat?
To a large extent, that sector is largely threatened, and that's because of because of perfect substitute. We're having a lot of cottage businesses now compete for margins. And because of that, a lot of the listed companies in that sector are getting more and more dynamic with their sources of revenue. Flour mills, for example, you've seen a lot of creativity around their products. Yes. In fact, flour mills has now started doing Gary. They've gone all the way. Yeah, so you're seeing, because if there's huge demand there, why stay
from chin?
Exactly.
Okay.
So why stay with products and you're struggling to make the right margins where there's a lot of effective demand? So it's about introducing products where there are effective demands.
I agree with you. Yeah. Disposable income is just there at the bottom of the pyramid. Absolutely. So if you're talking about 20 naira, 30 naira, 50 naira by kids, school children, those who are just saying, look, I just want to go to school, put that little thing in the lunchbox for kids. Absolutely. Why build a very big product for 10,000 and it's just sitting down there on the shelf and no one is buying it?
Absolutely.
So let's talk about big names like Cement, Boa Cement, Lafarge, and Dangote. It looks like the battle of these guys are just there. This is Boa Cement looking about $3 billion deal with the Chinese. Dangote Cement is also making some announcement. What's your play?
Yes, I think there's capacity. Like I said, because there's so much liquidity right now, aside from government, which is a major driver of demand or capital growth, the capex for government last year, for the very first time, as at September, we had seen roughly about 80% budget implementation. That's very impressive. If you roll that forward into this year, where the capex spend for budget has materially increased, you would see that there's going to be effective demand in that sector. Now, coupled with a lot of private sector now looking for opportunities. Real estate that didn't look like a very attractive asset class before, all of a sudden is looking very good right now. So demand in that sector demand for cement it's going to grow very strong.
Mohammed, if we go on the markets conversation, we can be here till tomorrow. We just love the market. Mohammed Garba, thank you so much. Have a great day from Cardinal Stone Partners.